passive strategy is to track a specific index performance in order to provide that investment performance to its investor. Now, although the tracking error is a good measurement of the uncertainty that you may take away from that target index, it doesn't necessarily capture everything, especially the drag and the transaction cost that may be incurred during actual portfolio management. In our first illustration, I want to show you how a typical fully replicated index tracking portfolio behave. Here, we're assuming a 25 basis point one-way transaction cost for monthly or quarterly rebalancing. We're assuming a 2% cash holdings to take care of flows. Although the tracking error in realized term is fairly small, close to 30 basis point, the underperformance of this tracking portfolio relative to the set 50 index is quite dramatic. So what really happens here is that due to the underexposure to beta in the portfolio, the cash drag is creating an underperformance relative to the set 50 benchmark when it is going up. And it's creating somewhat positive performance when it's going down. So the fluctuation in this return is creating uncertainty of that tracking performance that you don't capture necessarily with the tracking error. Instead of using a simple, fully replicated approach, we can use an optimized index replication approach. Again, we're looking at a tracking portfolio relative to the set 50 index. The active return in this case here is surprisingly small. Now, the reason is very simple. Even though we're still holding 2% cash in this portfolio, the optimizer automatically constructs a portfolio that minimizes the beta exposure, and therefore, there's much less actual beta drag coming from this portfolio. So it's demonstrated not only in terms of its fine tracking performance, but also in even smaller tracking error in ex-post terms. I know a lot of investors here are actually active investors, and you spend most of your time analyzing stocks, industries, trends, trying to identify good opportunities. So earlier on, we've described how factor models give you insight into the kind of style benefits in a particular market, such as Thailand. We want to see how active strategies can be designed using factor models by looking at factor exposures, which actually provide great screening because of the high quality data and the research that goes behind finding the right factors. And we also show you how you can actually combine factors, much like how you combine factors in a screen, to enhance your return or to create better hedging effect. And of course, we're going to demonstrate these examples using an optimizer that can help us generate that efficient portfolio. The first strategy that I want to illustrate is a value strategy. So this particular strategy is constructed using stocks in the MSCI Thailand Investable Market Index, targeting to outperform the MSCI Thailand Index. The backtest is run over the last 3 years, and if you recall, the performance of the value factor during this period was somewhat similar to this trend. So it hasn't been exactly the same, and that's because when we show pure factor returns earlier on, we're showing you returns that are analogous to running an unrestricted long-short portfolio with no transaction costs. When you want to study actual strategy, you have to take into consideration transaction costs and also the target risk tracking band you're operating in. So most of the examples I'm going to show you here have tracking errors between 5% and 12% range, depending on your characteristics. What we see is that the value factor, unlike pure factor, has a positive return and then lost it all in the last 1 year or so. A lot of it is contributed by industry, because in this particular example, we have not set specific constraint on industry exposure. And here we're showing you how not controlling unintended exposure can actually hurt portfolio performance more than your own intended exposures in the style and the specific contribution. The next strategy is an earnings variability strategies. If you compare them more carefully, they may actually look somewhat negatively correlated, month by month basis. Overall, the whole trend seems to be somewhat similar, but a small difference, a similarity here is that in both cases, we have somewhat fluctuating specific risk contribution or specific return contribution from the yellow columns. So you can see here that it has been a positive driver earlier on, and then it has been a negative driver later on. This is somewhat similar to value because these strategies were constructed using pure factors, and therefore we're not really targeting idiosyncratic returns. So it's somewhat difficult to control idiosyncratic returns with a lot of confidence. The next strategy is a long large cap strategy, but we've constructed it in a somewhat more interesting approach by constraining the overall portfolio size exposure so it's not excessive. Again, when we run strategies as such without tighter control on constraints, you can get unintended returns. In this case here, pretty sizable negative returns from industry. The next factor is perhaps a more interesting one because we're moving on to the yield factor. The yield factor, quite similar to how the pure factor return, actually has a positive contribution over the last few years. So it seems like a pretty interesting strategy to adopt. And one additional good thing about this strategy is that there is a fairly good distribution of return coming from three sources: idiosyncratic return, the style return due to the yield strategy, and also some positive industry returns. And what about low volatility strategy? Does that work in the Thai market? In the last few years, if we use low volatility as one of our alpha signal in the portfolio construction, we can actually see quite sizable contribution to our portfolio active return relative to the market. There's positive return not only from the style, but also in terms of the idiosyncratic returns represented by the yellow columns. And my sixth example is growth strategy. We know earlier on that growth strategy is not always the best performing strategy, so what we're doing here instead is to take a contrarian approach by betting into stocks with low growth strategy against stocks with high growth. This basically is built on the premise that historical growth is not an indication of future growth, and therefore there's a bias in there. When you adopt such a particular strategy, you enjoy a positive return coming from last year, but a sizable negative return in the first 1.5 years. And it seems that most of the contributions are negative during that period too. So can we actually combine some of these different strategies and form something that is better? The first composite alpha that I want to show you consists of two strategies. Basically, long yield, which we know has a positive return, and short growth, which is not necessarily the best return driver, but seems to have some hedging effect given that yield is not strong when the market is strong, but short growth is actually one possible source of return during that period. The return seems to be fairly good over the last 3 years with an active return that's above 35% in cumulative terms. A lot of this is coming from style, but we also see interesting contribution from idiosyncratic return, which means when we combine two factors, we're getting some additional returns or alpha that is not captured by our style factors. So that's a good source of alpha that, is something that investors are always targeting, something that you cannot capture with the market exposures to different styles. How do we enhance that? We look at short volatility as an interesting idea, so we're going to input that too as an additional alpha. Volatility and yield appear to be fairly lowly correlated. The correlation is close to zero, which means that they act as pretty good diversification sources. Now, when you put these two strategies together, you have one strategy which is very strong, in the bear market since low volatility is strong. You also have a strategy that's yield, which is also strong in a weak market. So you're actually getting additional sources of return when the market is weak. Again, you see very good distribution of return drivers coming from style investment as well as the idiosyncratic portion that is not captured by the style. So this seems to be providing a fairly good amount of alpha in addition to the factor premium that you're capturing. Now, however, when I constructed the Alpha 2 strategy, the risk was a little bit high. It was in the range of 12 to 13%. And in order to construct a strategy that's more in line with some of the lower risk-bound asset managers, I then fine-tune the optimization using a very simple parameter, the risk aversion parameter. So by switching the risk aversion parameter a little bit higher, we are putting more emphasis on risk, and this will help to suppress risk in the strategy to bring it down. That brings us to a smoother performance in the Alpha 3 signal. The return is indeed lower too, because we're now targeting a lower risk level and a lower return. But what it doesn't do is destroy the structure of return. We continue to see positive idiosyncratic return from the yellow column, good factor premium from green, and a small bit of industry premium that perhaps one can examine in more details in future. If you look at the information ratio, it's quite clear that between our second and third combined alpha signal, we haven't lost information in any sense. In fact, if any, we have gained a bit more information ratio. So I want to tie it back to how fundamental managers actually look at things. And although this whole optimization may sound a little bit like black box, it really is a very simple concept. Let's recall that we have desire to create a strategy that captures yield. We want to short growth because we think it's contrarian. We also want to short volatility because we think it's risky and investment trend is not supportive. So how does that all tie in? From a single stock perspective, and we're going to take Maybank, Kimbank Securities. Anyone from Maybank? Nope. All right. Actually, the optimizer picked a positive holding for this stock back in 2012. So you can see how the active holdings jump from 0 to about 1%. So the left-hand scale is your active holding. So the active weight continues to rise, and it seems to be tied in very well with the period when the stock price was moving up. So the picking of this stock was very timed very well. So the contribution from this bet paid off tremendously, represented by the blue line. So by about May 2013, the active bet was dropped off just a little prior to the correction in the stock price. So again, we're not seeing detraction from our contribution by too much because the stock holding has been trimmed. So what does this good example actually tell us in terms of the fundamental of the stock? If we drill down into that period that we just looked into and look at its yield exposure and its volatility or growth exposure, we see something interesting. Recall that back in this period before the stocks was being bought at an active weight, the yield characteristics of the stock has actually improved while the volatility exposure has actually dropped. So given that yield is going up, volatility is going down, and growth is also going more negative, all three signals seem to suggest that this bet is the kind of bet that the strategy is looking for, and therefore it picked up a positive active weight. Now, from this period onwards, we saw a fast declining exposures to yield and a fast rising volatility exposures, as well as exposures in growth. So that seems to trigger the exact opposite of what we want, and therefore a selling signal that dropped the holding or active holding down to about 0 and then eventually tail off. So I think at this point, I'd like just to summarize quickly that systematic equity modeling is really at the heart of an investment process that most institutional investors would have designed to help them capture excess return steadily, repeatedly over time. We saw how the factor trends in the Thai market relative to Asia, as well as within the Thai market, demonstrate the kind of drivers within this portfolio. And I think you've also seen how capturing this different factor premium is not that difficult when you combine that with a simple approach that is transparent and appeals a lot to the fundamental style of investment. So with that, I'll open up the floor for any Q&A. Slide 20 is coming back. Yes. 22.
I have a question on the dividend yield.
Yes.
You are saying that Thai market is, interested in more dividend yields, or
Okay.
because I'm not quite sure how we relate it with the growth and the size of
Sure.
the graph.
First of all, I need to clarify one thing. You should ignore this statement first, because I really wanted to just talk about yield. So the yield factor here is composed of both dividend yield and earnings yield. So we're looking at two sources of yield, not just dividend, but also earnings yield. Now contrast that with valuation on a different metric, which is price to book and price to sales. That's represented in the pink. So what I'm saying is that, first of all, yield factor has been a fairly strong performance, meaning dividend yield and earnings yield combined as a factor. It's pretty much been very stable as a source of premium in stocks over this period. I think I also mentioned earlier about growth, but I was talking about growth relative to value. So less about growth versus yield, because I think yield itself seems to be a more independent style, whereas growth and value are somewhat different. Now, why are they different? First of all, we know that in many investing philosophy, there's a clear difference between value investor and growth investor. Value investors often look at mispricing that is being missed by analysts, missed by other investment communities. Often these kind of valuation mispricing happens in a small cap space. Growth, on the other hand, does not always fall into that kind of investment style. Growth is more about finding stocks that you think has a lot more growth potential that is being missed. So we're looking for growth surprise rather than a valuation surprise. So there's a difference in how investors focus on the investment style. When you look for growth kind of investment, you tend to look into areas where there are more high growth stocks. Tech, information technology industries, for instance, software services. In more recent years, social networking stocks. All these things tend to display higher growth. For those companies, valuation tend to play very little role. So investors don't pay so much attention to valuation. It's difficult to compare LinkedIn and Facebook by valuation. What investors often pay attention to is perhaps which one has more growth potential. Now, when growth starts to diminish for these stocks, however, then investors start to pay more attention to valuation. Because given that growth potential is not going to continue to exist in those stocks, then valuation is going to matter more because you don't want to overpay for stocks that are eventually going to have similar growth rate. So I think this one shows you how the investment preference have shifted between growth and value over time. And when the market was in a more bullish environment, you can see that the growth factor has a positive return, whereas the value factor has a negative return, signaling that investors are paying more attention to growth and caring less about valuation. When growth opportunities are diminishing because of the financial crisis, we saw growth factor tailing off, replaced by a preference for value again. So investors start to pick up stocks that are priced very, very cheaply because people have discounted all their growth potential. So again, you see somewhat reversing trend here when the value style starts to diminish, replaced by a preference for growth. Of course, more recent 1 year, it seems like both have somewhat tailed off a little bit, noticeably more in growth as possibly due to the volatility in the market that's creating more uncertainty around potential growth opportunities.
On the same slide, in constructing different composites, like do you use the historical data or forecast data?
So in this model, the data are historical data rather than forward-looking data. So in some of our newer models, such as the Asia Pac model, for instance, we do include consensus estimates in earnings yield, for instance, and also in growth forecast. But in this particular model, we're not looking at forecasting consensus type of data.
Thank you.
All right, so if there's no further question, I'll return the floor to the host. Thank you very much.
Thank you. So before our seminar comes to an end today, I would like to invite Mr. Rene Veerman, Managing Director and Head of Equity Analytics, MSCI, onto the stage to deliver the closing remarks as well as the key takeaways of today's seminar. Please invite him onto the stage.
Good morning, everybody. Before I say thank you to everybody for coming, a quick observation. In the late 90s, I was involved in setting up one of the local associations of the CFA in Europe. I started that with, we were at the board with 8 people. Clearly, this is a larger audience, so very impressive. What happened shortly after that was that continental Europe, the capital markets, institutionalized and professionalized really rapidly, driven by obviously the euro, which meant that investors had to look abroad for invested opportunities because their home market got bigger. When you start looking at more assets, you're going to need more tools. So one of the things we've talked about here is, how do you construct a market effectively? And of course, our indices are a reflection of markets. We try to be accurate and cost effective in the reflection of markets. And also, once you look at a bigger market, which tools can you use to construct portfolios? So what we talked through today effectively was how do you construct an index? And before we get questions about index construction, please let us know. I know that Rick got 24 hours heads up to do this presentation. So if he went a little bit quickly, that's the reason. So I have a team of 10 people here with me, so please feel free to grab them in the hallways. On index construction, one of the most frequently asked questions that I've gotten since I came here was, what's going to happen with the Thai index? And I think Rick gave the answer. We construct the Thai index by looking at market cap, free float, and liquidity, essentially. So politics doesn't come into it unless it affects one of these. That's a very straightforward answer, and that's the answer that MSCI gives on this. Then, of course, how do you construct a portfolio that tracks an index? You can use factor models, the Barra factor models, which Andrew just went through, and an optimizer, the Barra optimizer, to actually track an index. Or you can create an active strategy that tries to beat that index. Again, you can use portfolio construction methodologies. There's good news here. One, we can sell you an index. There's more good news. We can also sell you the tools. There's also bad news. We have actually started creating very smart indices called factor indices, which are essentially what was sold as active management previously. That's called smart beta. We didn't really get into that today. But our factor indices, including the minimum volatility indices, are getting significant traction, especially with asset owner clients at this point. So of the $6 trillion US dollars that track our indices globally, and we are the global leader in equity indices, a small but fast rising proportion is tracking these minimum volatility strategies. The takeaway really is because the indices are getting smarter, you need to learn more to get even smarter. And that's, I guess, what the CFA's continued education program is for. If I remember correctly, that's one of the things that we're here for. One of the reasons Andrew included formulas in his slides is that we can make sure that you can actually get continued education points. And he likes formulas, frankly. So with that, and I just wanted to thank our hosts for organizing this immaculate event and generosity and letting us being here in such great numbers. Thank you very much for attending today, and hope to see you again soon. Thank you. Bye.
Okay, thank you. We hope all the participants here have had a great time attending this seminar and gained some practical knowledge from the highly qualified guest speakers from both FETCO and MSCI. Have a great trip back home. And for all the slides presented by our guest speakers, all the slides will be delivered to all of you who have registered your emails right at the reception. Thank you for joining and have a safe trip back.